market had a whipsaw day, and the VIX got really close to breaking out again, but then it fell apart. And breaking out for the VIX now is $35 level that it's bounced off of twice. And people always tell you when the VIX get this high, you start to buy in. But how I would be doing that is selling puts. If you go to the S&P 500 and you try to sell the $3,500 put, it's like $15. Or it's $150 on the SPX, but the SPY is like $15. That means the break even is like 3,300, where you would get those shares allocated at 3,500, but you would already have that premium today in today's dollars. So selling puts is how I'd be bullish this market, but I wouldn't be too bullish this market. It's just too technically ugly. The one thing that I do like to see is that bonds are catching a bid. The 10-year note has had a crazy week, pretty big candle, and that sometimes starts things. So hopefully we get back into the territory where valuations for tech companies are supported more so. I'm not a huge guy that believes that interest rates directly affect technology companies, but they do affect the way that investors look at their valuations. So that's for sure. But the companies that are earning in the future are more in the NASDAQ than they are in the S&P. The Russell is something that's been just like super ugly, but we are at a technical buy point. So if you want to get into this market, like I said, I'd be selling some puts. For the Russell, 1,600 puts are probably pretty nice for you. The NASDAQ, I'd be selling that $1,000 puts and just going 6 months out. If we go into a full bear market, you're getting allocated for that. I mean, make sure you have the money and you're not getting liquidated. But if you do and you're getting into the market at 10,000, that's pretty good for a long-term investor. So that's something that, that's how I would be bullish this. Energy continues to be something that just keeps on ripping higher because more people are talking about it. There's ads. Everyone's talking about energy prices and the Russia-Ukraine war, which could get worse. But these prices are much higher than marginal cost, and commodities are about marginal cost because firms will drill until they're not making profit, and they're making plenty of profit while prices are way up here in the clouds. So we kind of had a reversal across the board today, where energy started up high and then ended up giving you, I don't know if it's a doji, I don't know what candle that is. That's a little Japanese language. But yeah, so hopefully bonds do catch up, and if they do, that's going to support equity indexes. But we're literally virtually on the door of a bear market where follow through is very necessary. I just don't think it's going to happen this week, where we're sitting May 12th. The SPX options, they settle the third Friday of every single month, and that's next week. So that's where I'd expect more volatility to continue, probably bring us down to the 3,700 range. But throughout this time, when the market's falling apart and you want to enter in, I'd be doing it by selling puts. If you want to buy calls and trade rips, that's all hats off to you. But I would also be stock replacing. I wouldn't be holding a bunch of stocks fully invested throughout this volatility. If you have, you've been hurt. You're definitely down probably 17% in your portfolio. But if you have cash on the sidelines and you've weathered this storm, I'd be looking in the NASDAQ. You can play the Qs. You can play selling puts on the Qs. All of the above, I think, are technically probably good ideas. But again, just be a little bit wary that there's a global recession on the verge of happening, in my opinion. And that doesn't mean that equities are just going to go down. It doesn't mean that a recession doesn't mean that companies stop making money. The first thing that they do is they fire employees. A lot of tech companies have a lot of employees that they could easily fire and make a lot of money, hit those earnings numbers. But there are companies like Apple that can't make enough chips. And it did have a little bit of a bounce today. It's totally broken down. And I was talking about how this could break down last week. But they could fire employees, but they do have a lot of like retail footprint. They are selling a hardware companies. If they miss a little bit, that takes their premium down so low because they have a huge premium built in. All these big tech companies have premiums because they never miss earnings. If there is a miss, That would be something that would send us much lower. And that would send the Qs lower, that would send the SPY lower. It's really important to realize how important Apple is, Microsoft is, Google and Amazon are to the market. So again, selling puts is probably how I would play this. Apple 120 put, I don't think we get there, but if we do, your allocated share is much lower than we are today. That's how I'd be bullish, selling puts, and trading calls if you want, but be very wary about when the options expirations are, because that's when the market's moving. And this market moves on derivatives. It's equity swaps or it's call options. And I wish there was, more like just mom and pop investors that can just, sit in and buy it at a good price and feel good about when they're getting into stocks. But that's not how it works. These things are buy high, sell higher, buy high, sell higher, buy high, sell higher. And then it's the first real big dip that just burns you and keeps on burning. So hopefully you guys are doing well in the market. If you're looking to feel bullish, I would be selling puts. And then secondly, if you're feeling really bullish, buying some calls, trading them quickly, because these things are going to be moving fast up and down both directions. Now, the last thing I want to show you is what gold has done, because gold has been just kind of in no man's land for a little bit of a while now. This $1,800 level, don't be trying to get rich on gold, but I'd be adding to the portfolio here. Physical gold is much better than having this paper gold, because that's really the problem. There's a lot of paper commodities, especially in oil prices. People are just trading futures. They don't have barrels of oil. They're not going to deliver barrels of oil. They're just trading it on paper, and that boosts the market cap of all of these commodities. So there is possible downside for gold if we really just, considered how much paper can be printed shorting this thing. But then again, conversely, if all of the gold market cap had to be physical bricks of gold, we would have to mine so much out of the ground, and the price would skyrocket probably to 2,500. So that's a little bit of my macro analysis for the day. Notice that Apple was severely underperforming the past 2 days. I think Microsoft is going to continue to underperform, and we don't really need their software. They're in everything. That's already priced into the stock. It's a huge company, but I don't like any single one of their programs. Everyone uses them, but they're something that could be replaceable. So the fact that this company is projecting out 35 years as if we're going to be using Excel and Microsoft Word in the same way for all that time, I don't know, man. They do have a whole different part of their business, just like Google. Google search is only a part of their business. It's the biggest money maker. Microsoft's biggest money maker is all those software programs. They do have high-tech parts of their business that do deserve a valuation premium, but I don't think that they deserve as much of a premium as they have into this environment where the Fed is absolutely against the stock market. So that's my macro analysis. Let me know if there's any questions in the comments section. Thank you.